Welcome to Market Call. Thanks very much for joining us. I'm Marilla Fernandez. David Driscoll on the show today. He's president and CEO at Liberty International Investment Management. He's taking your questions today on global stocks. Here's how to reach us toll free, 1-855-326-6266. You can email us as well if you have a question, marketcall@bnnbloomberg.ca. David, thanks for coming in.
It's good to see you again, Marilla.
Just wondering if your focus, because your focus is on global stocks, and we've now seen a little bit of traction with China and U.S. coming to some sort of early agreement, more trade discussions to follow, whether you feel a little bit better about American equities these days.
Well, it doesn't really matter to me because we are diversified globally. So in a 30-stock portfolio, it would be 4 Canadian, 13 U.S., 13 international. And risk on, risk off. So we had the risk off period when all the fear was out there about tariffs. And then we've had this big market rally back, given that they want to reduce the tariffs to maybe 10%. And really the moral of the story there is that you cannot time the market. So don't be sitting in cash. You have to be invested because of what happened on Monday where we got the one-day rally of 3 or 4%. So it's just a matter of being diversified in this environment. So whether we get stagflation, slower growth with inflation, or a bull market again with interest rates going down, you still have to be invested.
Did you have investors or clients wanting to pivot away at all from what they had in the U.S.?
No, not at all. Because it's not where the companies are domiciled, it's where the revenue stream is coming from. And therefore, it's really just looking at the companies and not paying attention to the price to decide what do you want to own, what's the best way that you can diversify your portfolio and act accordingly. So what I always try to suggest to investors is when you're thinking about buying a stock, you have to answer 3 questions. Number 1, why am I buying this stock? So you need to write down 5 reasons that you want to buy it. What are the risks involved with holding the stock? And how does it fit in my portfolio? Because we want to avoid correlation risk as much as possible.
One thing I know that you look at, and you mentioned this metric, is return on invested capital. Tell me why you look specifically at that.
Well, it gets you through the slow times, the bad times, the down markets, the recessions, because companies that can earn a return on invested capital, so basically it's the NOPAT, the net operating earnings after tax, compared to the amount of capital that's invested. So it's a huge sign of how management is allocating their capital and whether it's good or not. So the old Buffett thought was if you have an ROIC or a return on invested capital of 15% or above, that's really good. And if your cost of capital is only 5 or 6%, then it's generating a ton of free cash flow, which management can use to continue to grow their business over time, good markets or bad.
So at this point, that is the metric that you continue to look for. And is it something you generally pass on to investors? Is it something easily they can look at themselves?
Yep, there's lots of tools out there that people can either look at the financials, the annual reports of the companies, or use some of the financial websites to learn about it and also be able to do some analysis themselves on it.
Got it. All right, we're going to take a quick break. David Driscoll is joining us. He's going to take your questions today. He's president and CEO at Liberty International Investment Management, and he'll answer questions today on global stocks. We're back in a moment. Welcome back to Market Call. We're going to an email from Jim who says, does David have an opinion about Cemex in New York? I'm interested in adding a Mexican stock to my portfolio.
Okay, Cemex is in the cement business.
Okay.
So it's extremely price sensitive and also economic sensitive. They'll do well when the economies are going great guns, and they'll do poorly when we get into recessionary times or things get stressed. The issue with Cemex, and it's up in the short term, but in the long run, the last 20 years, the returns have been essentially about 0 to 4%. So it just gives you an idea of what happens with a company when your return on invested capital is lower than the cost of capital, where the debt is piling up and you're paying more in interest rates for your debt relative to higher rated companies. Because this company has a credit rating of BB high, which is junk status. So they're always going to be paying a lot more than somebody who's a AAA rated company. And then you have to get through the ebbs and the flows of every economy. So it's not something in Mexico that we own. We own FEMSA, which is Coca-Cola bottler, the largest in the world. They also have convenience stores under the OXXO name and gas stations and pharmacies throughout Mexico, Latin America, South America. And if somebody wanted to really gamble, they could go for Mercado Libre, which is like the Alibaba of Latin America. But it's an extremely expensive stock, but the returns have been there. So you kind of have to take the good with the bad.
Got it. Okay, let's go to the phone lines then. Travis is on the line. He's calling from Toronto. Hi, Travis.
Yes, good afternoon. David, I'm a holder of Novo Nordisk. I've held it for about a year. Pun intended, it seems to have taken a lot of Wegovy, the stock. It's lost half its weight since then. I'd like to stick with it. It seems like there's too much news lately about Novo Nordisk, and they're scrambling. It seems like they're scrambling to keep their market share. I either keep it and sit through it, or I switch to Eli Lilly. What do you think?
Okay.
There are a few things all in here. So the news that came out with Novo is that they made a deal with Septerna to get oral tablets, to get off the Ozempic, the injectables, and get into tablets. So that's the big thing. The reason why Novo has fallen in the last year is essentially because, like many stocks that get into the mania, they went up too far too fast, and then have come down too far because when you look at the business, everything is in place. There are two major players, Eli Lilly and Novo. Eli Lilly has 60% of their revenues in the United States. Novo is 60% outside of the U.S. The biggest concern is that Eli Lilly's weight loss drug helps to lose more weight than normal, but you still have type 2 diabetics that are growing around the world, especially in China and in India. And they're going to have their place in the sun. I look at the company today trading at roughly 16 times earnings, which historically has been the lowest it's been in almost 20 years. So the value is there. The company is not getting any value for any of their weight loss drugs right now. So to me, this is a reason to continue to buy more. I would not hold both because then you're getting into correlation risk, so that they're moving in tandem for the most part. So we own Novo. We've held it for a long time. We continue to buy more.
Got it. Okay, let's go back to the phone lines. Michael's on the line from Vancouver today with his question. Hi, Michael.
Hello, Marilla. Hello, David. David, thanks for taking my call. My question today is on Coloplast. It's had a rough last year and last couple of years, I guess. I think that Liberty has liked it in the past, and I just wondered in the current market environment whether you still like it or have you changed your analysis on this one. I'll hang up and listen to your response. Have yourselves a great day.
Thanks for that. So they make healthcare products and services?
Think of colostomy bags, wound care management, all of the things for stomach and ostomy, which of course is not going to die anytime soon because with the aging population, it's a big market. So when you have to think not of the price, you have to think about the company. A long time ago, I was bragging to a boss, we're circa 1991, that I was up 1,000% on a stock option I bought. And he's sitting there eating his lunch, doesn't even look at me. He says, "You sold it yet?" And I said, "No." And he said, "You haven't made anything." So the stock price only matters on the day you buy it and the day you sell it. Everything in between is noise. You have to be focused on the company. What do they do? What are the metrics? Is there a future for them? And the answer is a resounding yes for Coloplast. The problem that's occurred with medical device companies since COVID is elective surgeries has slowed down. Hospitals can't afford, they're running short of funds available, and therefore they're delaying all of their inventory add-ons. But when you look at the metrics of the company, they're generating this year close to 5 billion Danish krone in free cash flow, which is up about 15%. And the revenues themselves are growing at roughly 6% when you compare that to 2% for overall global GDP.
Okay.
You've got a business that continues to grow. It's just nobody wants to be in medical devices right now, or that
To
kind of
invest in medical devices?
Yeah, because that's where the weakness in the markets are right now. Number one, in the United States, because of Trump's and
Decisions, yes.
decisions and orders, along with Kennedy, and the fact that all these tariffs are coming into play, and where are your manufacturing plants, how much of your product is being sourced, and will pay higher tariffs, and can you raise prices? But at these levels, I mean, you look at ROIC versus WACC. So the return on invested capital is sitting at 13%. The cost is at 6%. So they're generating free cash flow. They're converting their cash into, or they're converting the profits into cash. They've got lots of flexibility. They've got a new CEO named. So to me, this is a very cheap stock right now.
Got it. Okay. Let's take a quick break. David Driscoll sticking around to take more of your questions when we come back. Welcome back, and thanks for joining us on Market Call. We have someone on the line right now, Martin, who's holding to talk to David. Hi, Martin. What's your question?
Yeah, I've got a question on Amazon. It doesn't seem to be moving like the rest of the tech stocks lately. Has its time come, or is it a hang on and see what happens?
Okay, so Amazon has, thanks for your question, has come back like many of the other tech stocks since the dip April and early part of May. What's your forward look on Amazon? They've got a few things going.
Well, they've got some pluses and some minuses. So, excuse me, Amazon is involved in quantum computing like IBM and Microsoft and Google, but they're also having to compete with, shipping to the closest store. And also unionization. They're trying to continue to push that back. The other problem is that on the e-commerce side of their business, their operating margins are pretty slim. Where they make their money is with AWS, their cloud computing. And the stock went down the last quarter simply because it wasn't up to snuff. Revenues haven't been growing at the same pace as they had 5 or 10 years ago. So revenue is growing at 50%, then 30, then 25. So you see that the old law of diminishing returns comes into play, because you can only get so big before every addition has to be much bigger than the last. So the reason I don't like the company is simply because in the AI space, our choice was Microsoft. I don't want to own all 7 of the Mag 7. Because again, they're all interlocked, so one is enough for me. And then from an ethics perspective, I'm not a big fan of Jeff Bezos, or the fact that they don't want to allow unionization, or if you want to start a union, they'll just fire you, get rid of you. So I like companies that will take care of their staff and their customers and not be the way that they are.
Okay. Question about whether or not there would be concern about the company from investors because of the trade war. I imagine they import a lot from China or other markets affected by American tariffs.
Well, a lot of the AIs are also buying within. So, AI chips, everybody's got to continue to buy AI chips. And then it just becomes, at what point do they start to earn an economic return? If they don't, then they're going to start cutting back on AI spending. Meta continues to spend. Microsoft and Amazon have been pulling back a little bit. And again, we have no idea after 90 days from now what the world's going to look like. So you're going to get a lot of volatility in these Mag 7 stocks, good or bad. The dividend isn't that great or large, so it's not the best place to be for retirees who are looking for income to live on. And it almost forces you to have to trade the stock as opposed to invest it and hold it.
Got it. Okay, let's go back to the phone lines then. John's on the line from London, Ontario. He has a tech question, I believe, as well. Hi, John.
Hi, Marilla. Hello, David. David, I've been trying to buy Taiwan Semiconductor for some time now, and it keeps defying my ability to do that. Now, do you believe in this super mega project in the U.S. as a hedge probably against China takeover? Or should I buy that, or should I buy AMD, which just announced a $6 billion share buyback? Thanks very much.
Yeah, Taiwan came out very early under Trump and said, hey, we're spending a lot of money bringing part of our business to the U.S. Do you think it's going to happen, I guess? Is that where the investment is for them?
If you want to build a foundry, it's going to take you about 10 years, and you need access to water. So there goes Texas, Arizona, et cetera, where there is enough water to be able to supply to keep the manufacturing plants cool enough.
Okay.
In Japan, there's a prefecture in Japan that pushed away building a foundry there because they didn't want to give up the water for the food that they're growing. So yes, the overhanging is the geopolitical risk that if China goes into Taiwan, what's going to happen with Taiwan Semiconductor? Secondly, what's Trump going to do? Because only 10% of foundries are in the United States. Everything else is in Asia or Europe. On top of that, TSMC has great products. They are the leader. There's an alternative in Europe, ASML, that also provides lithography, which is a little bit different for the kind of foundries that they're creating for AI. We own ASML. We wouldn't own both at the same time. But I have no problem with TSMC other than you have to understand the volatility that's going to be behind it with geopolitical risk and how much is it going to cost, how long is it going to take to build these foundries.
Yeah. Okay, let's go back to the phone lines then. Charles on the line from London, Ontario. Hi, Charles.
Hello, thanks for taking my call. I'm an owner of BCE. I bought it for income, and it's been a total disaster recently. I'm wondering if I should just dump it and take a capital loss. And my other question is, the board has lied to investors in that they said that they would not cut the dividend this year, and they went ahead and cut it in over half. Is there any recourse that investors have against BCE? Thank you very much.
Okay, BCE, of course, parent company of this channel under the Bell Media brand. There was a lot of pressure on them to cut the dividend.
Which they did.
Which they did, 56%.
Yep. And for class action lawsuits, it's a matter of getting shareholders together if they can prove that they're, on purpose was trying to mislead investors. So there is an avenue in that regard. BCE, the telecom, like Rogers and the other telecoms, is dealing with price competition at a time when they were building out their 5G networks, which cost them anywhere from 20 to 30 billion in debt. And as a result, pricing power has disappeared, just like the European telcos and other places around the world, where they can't raise prices, therefore the profitability has been flat. Immigration has slowed down, so new additions have started to go flat as well. And as a result, with lower profitability came the lower free cash flow, which had a huge impact on the ability to pay the dividend. So, and then the latest acquisition in Washington State just doesn't make a whole lot of sense. We own TELUS, we own Cogeco, which is a small cap. In that neighborhood, they're doing a little bit better than the other telcos. But for now, dividends with TELUS and Cogeco are not in doubt. But again, there has to be some way to pay down the debt while growing the business. So right now, pretty much all you're getting is the dividend yield and very little growth.
So you're sort of tepid on telecommunications
In general, and BC I wouldn't touch.
Got it. Okay, we do have to take a quick break. When we come back, we'll have a look at David's past picks. That's next. Welcome back. Time now to take a look at David Driscoll's past picks. These are from December 19th of 2023, so we're going a little bit further back. At the time, we picked Cogeco Communications on the TSX. It was $55.77. Now up to $66.28 at 19% upside here, 29% total upside. They do cable, essentially. I'm just wondering why you picked Cogeco back then.
Both sides of the border. Number one, the dividend yield was very high at the time because the stock had gone down. So we were looking for beaten up stocks that had more to offer than just price growth. Secondly, they are allowed to hop on to the Wi-Fi networks of the big telecos, which means they are now becoming more of an asset-light business where they don't have to spend on capital expenditures and can see pass-through of higher margin business and the dividend continuing to grow greater than 10% a year.
Do you worry about that changing, considering there's a fight over regulation generally?
Well, there's always that risk, but in the meantime, they just continue to do what they do. The other reason that we were picking these, and it's nice that it goes back to 2023, because we're not picking a stock based on price. We want to buy the business and let it run over a 10 to 20 year time horizon.
Got it. Okay, let's go to your next past pick from December of 2023. Atrion at the time was $350.53 American. It was acquired. We wanted to point that out at $459.92. So that was last August. So 31% upside return, a 32% total return upside. Tell me a little bit about the background ahead of it being acquired.
Well, Atrion was a small cap medical device company that was making tubing for IV units and blood operations. So they had a small little niche that they were able to continue to grow their business in. They sold out to a company called Nordson in the US. I think it was mostly because management, the owners of the company, were getting old and wanted to monetize their retirements and sold the company because the $460 price was a lot lower than what we had it valued at.
Okay, so
that's a risk that people have to understand when they're investing in small caps, is that they can disappear often from takeovers, whether it's management deciding that they want out or that there's something investable in the company that's attractive.
And then it went off the table.
Yep.
Got it. Okay. Let's go to your last pick from that year, which was December of 2023. Jardine Matheson, which is a holding company. At the time, it was $39.78 American, went up to $48. Today, $13. A return of 21%, a total return of 31%. Tell me a little bit more about them.
They're a big conglomerate in Southeast Asia, so they would own dairy farm supermarkets, the Mandarin Oriental Hotel. They've got the BMW and Mercedes dealerships throughout Southeast Asia. Most of their revenues are coming from Indonesia, but they do have about 25% invested in China. So this is our stock to be a proxy for investing in Southeast Asia.
And what specifically did you like about this holding company versus others?
They've got their tentacles throughout every country in Southeast Asia. They're an A-low credit rating. They've got lots of capital, so they can continue to make acquisitions and continue to grow the business. And the dividend yield is sitting right now around 4.5% to 5%. So you're getting paid while you wait.
Got it. Okay, we are going to take another quick break. Then we're going to be back with David Driscoll taking your questions. We're back in a moment. Stay tuned. Welcome back. Let's go right back to your phone calls to get them answered. Simon is holding on the line. He's calling from Montreal today. Hi, Simon.
Hi, how you doing?
Oh, we're good. How are you?
Okay. So I'd like to know about Danaher Corporation.
Danaher. Okay, let's have a look at that. They do
Life
medical
sciences.
and industrial.
They're life sciences. So
Okay, generally.
they make the equipment for the laboratories and all the biotech firms. Again, since COVID hit, everything's slowed down. And now you're getting more pressure from the US government on universities, on the NIH, et cetera. That demand has essentially just kind of slowed down completely. However, the long-term viewpoint for both Danaher and a company like Thermo Fisher, which are both in the life science categories, is as new drugs are being developed, they will still have to use the equipment to help develop it. And that's why we still hold the Danaher. The first purchase was around $70, went up as up into the 200s and is now trading around 190. But again, look at the business. They have products that, governments, universities, hospitals, biotech companies need. And it's just a matter of waiting until that demand starts to pick up again.
That being said, we have another 3.5 years of Donald Trump. We know that he likes to rein in costs. And we know he's been, as you mentioned, pressing hard on universities and research. So do you figure that what has happened now, which is that slowdown, could very well continue? Or will it percolate up just on its own? Or will the U.S. have to back off for that to happen?
Well, to me, this is a buying opportunity for these types of companies that were trading at high multiples that have come down, where they're fairly cheap now. And don't forget, as I said before, it's not where the company is domiciled, it's where the revenue streams are coming from. Remember, there are only 400 million Americans and 7.5 billion people living outside their borders. So there's lots of opportunity for sales to continue to grow, just not at the pace that they were prior to COVID.
Got it. Let's go back to the phone lines. Len's on the line. He's calling from Simcoe today in Ontario. Hi, Len. What's your question?
Hello. My question's on Berkshire Hathaway, B shares, of course. It seems that since Buffett announced he's stepping down at the end of the year, the stocks have not only taken part in a rally, but they've fallen some. Should he not have people trained by now to take his place? Or is that not the reason the stock isn't performing like some of the other major stocks are? I'll hang up and listen to your answer. Thank you.
He's handing off to somebody he's trained and been with him for a very long time.
Oh, yeah.
I think
Greg Abel's been there for decades.
the cachet of Warren Buffett is something people are going to miss, and maybe that's hitting the stock?
Yeah, because he's still one trick pony for the most part when he wants to allocate capital, such as buying all those Japanese trading houses 2 years ago. Was it his choice or was it Greg Abel's? The other thing that you have to remember is what happens when he is gone. What will the results look like? It'll be a stable company moving forward because they're diversified through all kinds of different businesses, and predominantly in insurance, which is doing a lot better than the banks are right now. So again, the day you buy it, the day you sell it is important. Everything in between is noise. If you look at the company is set up to continue to grow over time. It's just how Greg and his team is going to allocate their capital moving forward.
And that happens, I guess, at the end of the year into 2026?
I believe so, yeah.
Yeah, got it. All right, let's move on to Mike then, who's calling from Toronto. Hi, Mike. What is your question today for David?
Hi, my company is IBM. I would like to guess 3 to 5 year outlook and whether it's a buy, hold, or sell. Thank you.
Thanks for the question. So let's have a look at
You're hitting me with an outlook. Okay.
So IBM, where were we today? Let's pull up that price chart we just did. It is up 85% over 3 years and sitting at 257.05 today, down a little bit.
Okay, expected earnings, 2025, $10.88 US, 2026, $11.61, 2027, $12.30, which would bring it down to a multiple of about 20. The good side of IBM is they are part of this quantitative computing side. It's unfortunate that previous CEOs didn't pay attention to the ability of Watson and giving it the kind of value or attention that it should have gotten.
Yeah, it's been slower growth compared to everyone else.
Yeah. So they spun off the hardware side. They're basically software now, but their focus truly is if they want to have a big rally in the stock price, it's what's coming next in the next 5 or 10 years with quantum computing. Because if you can use nuclear fusion or fission to be able to compute at millions of times faster than AI chips, then you get something going for you. So that would be IBM, Microsoft, Amazon, Google, DARPA, of course, Toshiba in Japan, and Thales out of Europe.
Is IBM as aggressive on this as it needs to be compared to the competitors?
Well, against the competitors, its access to capital is going to be able to deem whether they're going to be able to put enough money into it to be one of the...
And do you feel like they do have that access?
No, that's why we own Microsoft and not IBM.
Got it. All right. Let's move on to Roger then, who's calling from Surrey today in BC. Hi, Roger.
Yes, good morning. Thanks for taking my call. I have a question on Alimentation Couche-Tard. I've been a holder for quite a while now, and obviously in the last while it's dropped quite a bit. Would you still hold the stock, or should I be trimming the position a little bit? Thank you.
Okay, thanks for the question, Roger. So Couche-Tard, of course, has been trying to unwind a deal here in Japan and take over some 7-Elevens in the U.S., but it seems quite complicated, and they're still far from that.
At least they got access to
that was the latest step.
To the data room. And the stock's going to go sideways while all of that is going on, because this could be a $46 billion acquisition for a company whose market cap is $64 billion.
Okay.
So it's a big, well,
it's a
I don't want to, no, I don't want to
deal.
say it, but I could call it the big gulp.
Oh, geez. Okay, there we go. That's your one for the day.
Okay. But nothing's going to happen with the stock. It's trending sideways because sales are fairly flat. This is the acquisition they want to make to start to move the needle again. If they get that, then it's pretty a big dominant position throughout the world.
And just so we're clear to the caller, because of the size of the deal and because there is divestment involved, right? They'd have to get permissions, that kind of thing. Mm-hmm. We're talking a long sort of roadmap ahead.
Yeah, it was always interesting when they made an acquisition after Circle K, where they'd be spending $1 million to rebrand from whatever it was before to Circle K. So these processes don't happen overnight. They're going to take a few years. They have to go through all the government regulations and sell off some portions if 7-Eleven is open to selling the company.
Got it.
If not, then they'll be out on the hunt for something else.
Yeah, definitely there's been some resistance to that as well. All right, we're going to take a quick break, line up more of your phone calls. We're back in a moment. Welcome back to Market Call. We are going to Jack on the line, who's holding from Calgary today. Jack, what's your question?
My question is on Parkland regarding the acquisition by Suncor, right? There's a certain amount of arbitrage in the price of the share now. Like Parkland's about close to $40, and I'm wondering, do you think that that'll go through because they have some issues with one of their shareholders there, Simpson's Oil, plus also regulatory problems. I'm just gonna like to hear your guest's opinion on it.
Sure. Thanks for the question today, Jack. So there's a lot going on with Parkland. They have an activist investor. They are sort of fighting over what to do for looking for the company. What's your take, first of all, on the situation they're in?
Well, I believe it's Simpson
Oil.
Oil, yeah. It was pushing management to sell stations, pay down the debt. And of course, when you're looking at companies that are private equity-ish, they're always going to want to be flipping companies because that's where they get the short-term returns. Parkland was not doing as well as Couche-Tard as far as gas stations and growth in the industry, and that's where the pressure was coming from. Let's remove the board, let's remove the executives, and because nothing was changing and there was pushback, then Sunoco comes along, says, hey, well, we don't mind taking it over. You're going from a company that has a credit rating of Parkland at BB, Sunoco is at BB high. So if you own the shares, now that we've had this big rally upwards, it's probably a good idea to be selling it rather than accepting what happens down the road.
Okay.
Because you've got just as risky a company as you've had before.
And that's if this happens.
If
what
it
about if it doesn't?
Well, this is, I imagine the stock price will come back down into the low 30s.
Got it. All right. There's some advice for Jack. Let's move on to Jill, calling from Belleville, Ontario today. Hi, Jill.
Hi, good afternoon. Mr. Driscoll, I would be interested in your comments on Enghouse. I've held it a couple of years and am interested in it as a long-term hold. Thanks very much. I'll hang up and listen to your response.
Okay, so Enghouse was just engineering design, I guess? Is that what they do?
Yeah, it's software as a service.
Okay, so they do they're at 26.16 today. What's your take on Enghouse?
Well, we've owned it for a long time and we will continue to hold it and buy more. You're getting essentially an 18% dividend increase every year, which makes the investors happy. With software as a service, they're kind of taking on the Microsoft business model. Instead of selling the software, they're going to license it and take subscriptions, which kind of smooths out their margins from quarter to quarter. Most recently, they've made 2 acquisitions in Europe for public transportation, car rental, taxi. So it's the ability to book and pay for rides. So it's kind of like Presto here in Toronto, where they're going to take over the software and be able to do all of this automated payment system. So since that announcement was made, the stock price went from 24 up to 26, where we are now. But again, it's just margins are growing because of the movement to licensing as opposed to selling software. They are asset light. They have no debt or very little debt. They continue to make acquisitions. So this is what's known as a serial acquirer, which are the types of companies that we want to hold, because they tend to do best in the long run, talking 10 to 20 year time horizon. Because if you think you're growing your revenues at 4% organically, and then you're adding another 2% in tuck-in acquisitions over time, and you have the return on invested capital relative to the weighted average cost, you've got a company where you can sit back and just continue to accumulate. So the ROIC for Enghouse is at 15%, which is what we're always looking for. Cost of capital is at 8.5%. So they are generating a ton of free cash flow they can use to make their acquisitions. If there's any debt involved, it can be paid off within 2 years. So it's just rinse and repeat. And over time, somebody's going to start to notice it because it's a small cap company that nobody in Canada is paying any attention to. But when it gets its legs, it's going to start to move. And then when it becomes a mid cap, all the mid cap managers have to buy it, so it'll double again. And then when it becomes a large cap, that's when all the large cap managers find it, and it doubles a third time. So this is why we look at some of our small caps with the anticipation that this is what's going to happen over time.
Got it. Okay. That was for Jill. We're going on to Lynn calling from Vancouver. I think this could be the last question for the hour. Lynn, what is your question today?
Good morning. Thank you for taking my call. I'm interested in Medtronic. It has corrected significantly. I'm wondering how tariffs will affect their medical equipment. And I also noticed that their headquarters is in Ireland. Does that put them in the crosshair of Trump, given they're not in the U.S., even if they're U.S. listed? Thank you.
Okay, thanks for the question. A lot of
okay, they're in Ireland for tax purposes.
Yes, which everybody is.
They were in Minneapolis. That's really where their headquarters is. But in Dublin, you will find a lot of medical device and tech companies for tax purposes. They make pacemakers.
We're getting a lot of medical equipment questions today.
Yeah,
yes.
atrial fibrillation. So Medtronic has not had any performance pretty much for the last 20 years. Again, since COVID, we'll say again that demand has fallen, pricing power has fallen off. The last 20-year returns for Medtronic have been roughly 3 or 4% compounded annually. So the dividend's not growing at a huge pace, and therefore it's just a stock that I'd stay away from.
Okay. We do have to leave the questions there at this point, but stay tuned. Dave's going to share his new top picks. That's when we come back. Join us tomorrow for Market Call. Rebecca Telcher will be on the show. She's portfolio manager at New Haven Asset Management, and she will take your questions on Canadian dividend stocks. That's tomorrow. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. We're back in a moment. Welcome back. Time now to share David Driscoll's new top picks. We begin with Alfa Laval AB, which is a Swedish company. They do fluid handling pumps and valves, heat transfer. It sounds very interesting.
It's in many industries. So there's marine, there's food, there's pretty much every industrial that they're in. And it's just a way to be more efficient and less polluting. So here you have a return on invested capital of 15%. Cost of capital is 9%, leaves lots of room for free cash flow. Dividend's been growing 12% a year. The compound annual stock growth rate has been 12% the last decade. So another old saying that is the dividends grow ultimately the share prices will follow. They have to.
Do they primarily operate in Sweden? Are they across Europe? Where are they?
Again, that's where they're domiciled, but they're doing business all around the world.
Okay, and they're growing.
Oh, definitely.
Got it. Okay, let's get to your next pick then, which is Comfort Systems. They do industrial heating, ventilation, that kind of thing. Tell me a little bit about what drew you to Comfort Systems.
Well, again, having to cool data centers is going to be part of their business. That's where they've been seeing a lot of their growth. And then you look at the business relative to others like Honeywell, where they're making 29% on their return on capital, which is huge. The cost of capital is at 12%. The dividend has grown roughly 40% in the past 10 years, and the return's been 35%. It's a small cap stock. It's extremely volatile. It can trade $5 or $10 a day. So people I would start with a small half position and then grow it out from there. But again, if they're all just domestically in the U.S., so no tariff concerns, or the government will support them because they are homegrown. It's not
a cheap stock. It's at $4.70. You said it rallies sort of between $5 and $10 sometimes in any given day.
Yep.
So is it the kind of stock, if you're waiting to get into, obviously long term doesn't matter so much, but if you're waiting to get into, should you wait for the drop? Is it volatile enough that it's worthwhile waiting, or just sort of dip in generally?
If I was an investor at home, if I had $10,000 to invest in the stock, I'd put $5,000 in today. Let's just get the dividends coming in. We'll see what happens with the growth, what happens in the economy. If the stock falls dramatically when it shouldn't because the metrics are good, there's the opportunity to buy the other half.
Got it. Okay, let's go to your third pick then, which is Intertek Group, They're in London. So we were talking a little bit about this at the break. They do inspections of all kinds. Unwind that for me. What do they inspect? How big of a company is it?
Well, they're quality control assurance. They're a small cap company, but they've got 5 large competitors, but they're growing at a faster rate than those competitors. So toys or food or auto parts, everything that has to be inspected, importing and exporting, they get a piece of the pie. They do the certifications. And what we're getting is a recent acquisition in Brazil, building and construction industry, growing its geographic footprint in Latin America. Return on invested capital is 18%, the WACC is 11%. So the dividend's been growing 17%, and the stock price has risen 12% compounded annually. So here's a small cap stock out of Britain, but it's got its tentacles throughout the world, and it's doing better than its competition.
I was going to say, are there a lot of these companies that do this kind of thing?
Yeah, SGS, a couple of companies out of Europe as well. SGS is Swiss. So they're out there, but they're not growing as fast because they're larger, and therefore, again, every new acquisition they make is going to have to be bigger than the last. Whereas Intertek is just in the middle, or in the sweet spot right now, growing their business, having greater cash flows and margins to be able to continue to acquire and grow their business.
With this kind of inspection business, do you need a lot of capital? I mean, I imagine everything's coming into you for inspection. Is it more about manpower than it is about what you have sort of in the building?
This is what we call asset light,
yes,
too, where your current assets are greater than your total liabilities. So no, it's not a capital-intensive business.
Got it. Okay, I do want to circle back to what we talked about at the top of the show, which was a way that you look at, a metric that you look at when you are sort of deciding what to put your money in, and carefully what that metric is and what it shows, which is return on investment, essentially.
Yep, free cash flow, because in your own life, if you've got money left over after all the bills are paid, you have financial flexibility. If you want to learn more, the December newsletter on our website explains everything, or what we do, why we do it, and why we're not going to change. And then the March newsletter talked about risk on, risk off, and how investors have to deal with the volatility.
Give me some of the advice along those lines, risk on, risk off.
Well, diversification is the most important thing when you get a risk-off scenario where interest rates are rising, inflation is rising. If that's happening, stock markets will go down because you don't fight the Fed. Interest rates go up, markets go down. Interest rates go down, markets go up.
So as you know, I know you're a more long-term investment holder. You kind of look down the line. A lot of people have had a lot of fear and panic in a short period of time. So when you face an investor whose emotions are involved, and you know, some of them are retiring or already retired, and so the money literally just drops away for them, what do you say to them? How do you advise them through something like this?
When we meet them for the first time, think of me as a financial contractor. Tell me what you want and I'll build it for you. But we do the financial plan first, and then everything leads into what the secondary of creating the portfolio, having structure in place, discipline, and non-correlations, so we're diversified throughout the world, as well as bonds.
And you won't deviate unless there's a crisis, essentially.
Well, there'd have to be some significant red flags that pop up to want to sell the stock.
Got it. Okay. We are going to leave it there with David Driscoll today. Appreciate you coming in. Thank you very much for sharing some of your time. We'll see you again soon.
Great to be with you again, Merle.
The hour flies by. And for all of you, thanks for joining us on Market Call. We're going to leave you right now with a look at the North American markets, and we'll see you again tomorrow.